15 Minutes with Marlon, trending news and headlines.
Welcome back, everybody, and thank you for being here. This is 15 Minutes with Marlon. Listen, this is episode number 5, and we're going to bring to you today's headlines and a couple good questions that kind of came about. So, Alex, take it away.
How is construction costs impacting future development?
So, construction costs are dropping, right? Construction costs are dropping. And today was a very interesting post that I came across on LinkedIn that said, probably from one of the most well-respected researchers, most well-respected individuals in real estate altogether, that's looking at data. And the post indicated that construction will pretty much slow down or completely stop, right, between 6 months and the next 12 months. And what's going to happen to pricing? Guys, it's what I've been thinking about since the pandemic began. Pricing is going down. Material pricing is going down. Labor is going down. This is simple economics, guys, right? All of a sudden, there are more laborers, there are more contractors, there's more subcontractors to do brand new construction projects. There's more of them in the market, or that will be in the market in a few months when some of these projects that have already been started finish. And what's going to happen? You're not going to see a lot of new projects breaking ground. You're only going to see very select projects, right? Very select projects, high-level multifamily, things that I'm hearing sort of in the network. It's high-level multifamily, medical offices, next door to hospitals, some single-family, suburban type or townhouse type products. Those are some of the projects that are going to be moving forward. Industrial will continue. Obviously, retail, hotel, typical office. Those are all going to take a big pause for a long time. Right? But they will come back, but it's going to take a long time. They're going to be paused. So what does that tell us as developers, as guys that are going out there and putting in deals together to come to the market with new product? It tells us that our construction numbers are going down. Right? So whatever we were building it before, we're going to have the opportunity and the benefit of having a larger labor pool and materials that are on slow or haven't been moving too much. So that's a positive thing if you're looking to develop in the future. On the flip side, lenders are going to be more reserved, right? They're going to require higher level requirements, and they're going to look at sponsorship, track record, history a lot more closely than they probably did in the past. So some good, some bad. Overall, though, very positive, because if we're able to come to the market with prices, right, that we're going to develop and we're going to build projects lower than before, that means we can rent them for lower. So even though they're saying that rents are going to soften slightly, that's okay, because guess what? Construction prices will also soften, and we'll be able to move forward with very good quality projects. So, all right, Justin, next question.
Is the real estate market doomed now because of COVID-19, or will it come back in a year?
No way. So the real estate market is not doomed. All right, listen, the real estate market is not doomed. They said this back in the 80s. They said it in the 90s. They've said it they'll continue to say this time and time again. Every time there's a pandemic or every time there's an issue, that's going to happen, right? Real estate is doomed. Single family market back, in 2008, the biggest recession that we've had so far, that was supposed to just completely destroy the markets. Yes, look what happens, guys. Guys that are over leveraged, guys that didn't strategically buy things, obviously they took a dive. Obviously there were properties that went back and lenders foreclosed on. That's going to happen now, right? That's not going to change at all. It's going to happen now. People will be foreclosed on, but it's also going to be dependent on what asset class you're in. So if you're in hotel, retail, office, suburban office, those type of things, a lot more challenging, right? Very difficult. However, it doesn't mean if you have holding power and if you can make it through these, dips in this difficult time, you're going to come out ahead. That for sure. I mean, I always believe that. Real estate will always continue to improve. Yes, there will be a dip. There will be a correction. There will be all of that. But remember, we are always going to be building. We're always going to be renovating. Things are always going to be progressing. And that's more of a country thing, right? I mean, we've been progressing since we've started, since we became a country. right? That's always how it's been. However, our life cycles are pretty short, right? So even if it's 100 years, you're going to go through ups and downs and recessions. But overall, from when you started all the way to when you end, if your life cycle is 100 years, I guarantee you that trend is up, right? It may fall, it may stall, but it'll continue rising and it'll be much higher at the end. So when you think of real estate, you got to think generational, right? You're just one of the pieces in generational real estate, meaning you're building it for your family, you're building it for your shareholders, you're building it for, family offices, whatever it is you're doing, right? You're trying to grow for the future. So when you have that in mind, and if you go after real estate that either A, you could buy below replacement value, which now is going to be a good time for that, or B, you can build them in down markets like this one that we're going to be facing, where construction numbers are going down, material prices are going down. If you can build them for cheaper, then you're going to be able to weather the storms later on. So in my personal view, I think now is the best time to be involved in real estate. But I also think even at the top of the market, as long as you're buying at the right prices and making sure your bases are covered correctly, you're going to be fine. So just don't over leverage. That's something that, I always tell everybody, don't over leverage. Don't try to have 95% debt on your projects or your, acquisitions. Don't over leverage. Always remember that.
How did you invest in real estate to replace your income?
So one of the best things that you can do right from the beginning is whatever income stream you're generating your funds from, wherever that's coming from, grab some of it, save some and put it aside, right? What can you save? Can you save 20%? Can you save 10%? Can you save 5%? It's more of a habit. It's more of a mental thing because it teaches you how to not spend all of it. Or even worse, not go into debt where you're bringing in $100, but now you're pushing out 110, right? That's a bad situation to be in. So can you save 5%? Can you save 10%? Then, right, if your income stream is very low, it's very difficult to get involved in real estate unless you're very creative or you learn creative strategies, right? Meaning, can you partner up with somebody else, right? Can you tie up a contract and sell it to somebody else so that you can generate more income? In the beginning, it's not so much about investing as it is creating an income for you so that you can take those dollars when they become a little bit more substantial in size and put them to work. Once you can do that, and then you can do that repeatedly time and time again, then you'll be in a better financial position. So remember, in the beginning, it's really about generating as much income as you can through different income streams. Whether it's, like I said, flipping a contract, whether it's maybe you go into the real estate agent side and you generate commissions on sales because you need to take those commissions. And then if you've trained yourself over time, for every $100 that I get, I'm going to save 10 or 20, right? When you get the large commissions, the 100,000, the 200,000, you'll be able to save those. And once you have those, you may be able to put those into your multifamily or something that looks attractive that has value added upside. So the first and foremost thing you should do is try to save. Save, keep it aside, and so that way you can have some cash when you actually need to deploy it to invest in some of these real estates, because it's very, very difficult to say that you are tapped out, no cash, or you're just neutral all the time. How are you going to invest? And it's not really investing. Then it is, how are you being creative in creating real estate opportunities where you'll be able to generate some income and some cash for you, so that one day you can take some cash and invest it and put those dollars to work. So don't fool yourselves. In the beginning, real estate is about work. You gotta work, you gotta generate the income. Then when you have substantial amounts of cash, then at that point you put that to work. All right?
Is the current drop in the market a sign that real estate will be cheaper in the near future?
So in the near future, yes. Right? Anytime we see market dislocation, anytime we see prices starting to creep downward, we're going to see opportunities to buy. When those will be, are they 30 days from now? Are they 60? Are they 90? Are they 6 months? Are they a year? Are we 2 years away? No one can know. No one will be able to say it. But what I can tell you is, instead of just guessing, right? Inherently know if the market starts dropping, right? If individuals, companies are not able to afford the rents, right? Then that will bring prices down. Now, what's going to keep, prices somewhat, where they're at? I think interest rates, because interest rates are not going up. If interest rates would be going up, then next thing you know, your prices would be really crashing down. But since interest rates are low, and those that can obtain loans to borrow, to buy real estate are going to do so, then there's going to be, let's say 10, 12 different individuals or entities that are vying for those few assets that are in distress, right? So I feel there's going to be a little period of time where, yes, there will be opportunistic purchases, but long term, no. Long term, what will happen is, we've all talked about the U-shaped curve, the W curve, the V curve, all these different indicators. No matter what, ultimately, you have to look at each deal on a deal-by-deal basis. What's the deal in front of you? Does it make sense to buy today, or does it make sense to build today, right, for the future income stream you're going to create? If it makes sense, it's a deal. If it doesn't make sense, it doesn't matter if the rest of the market has dropped. That specific deal could take you down if you don't know what you're looking at. So you have to look at that very carefully on a deal-by-deal basis. And I think in the short term, yes, we're going to have some, opportunistic acquisitions. In the long term, I do feel that real estate, as it always has done, it will rise back to the top. So, all right, next question.
What is real estate investing like now in 2020 compared to last year?
Compared to last year, people were very, very bullish. There was a lot of investment capital on the sidelines, a lot of equity investors that were looking to deploy capital, even though prices were trending upwards, almost at the top. A lot of guys were talking about market bubbles. A lot of guys were talking about prices that were not sustainable. Now, we're talking about a whole different topic, whole different theme now. Now it's our rent softening, where's the post-COVID discount, what's going to happen to the tenancy, what's the quality of those tenants, how do they need to underwrite for interest, and reserves. Those things are changing. So that completely changes, one, the psychology of the investor that's going to buy, acquire, or develop real estate. And two, it makes them more cautious. They may have X number of dollars sitting, waiting to be deployed. Last year, they might have taken the jump. This year, not so much. No one's in a rush to jump in and buy real estate at this very moment in time, unless, and I said this before, unless it's a specific opportunity where you have upside that you can create through construction and development, which your value creation is substantially large, or you're seeing a lot of very cheap, below replacement value. Let's say an Anchorage store that went dark and all of a sudden would normally trade for $200 a square foot. Now it's going to trade at 130. Maybe there's that type of opportunity, but I don't see anybody rushing right in and trying to buy things just for the sake of buying, because fundamentals are always the fundamentals. You're either going to buy below replacement value, you're going to buy in A+ locations, or you're going to create real estate and through construction development create substantial value for yourself, your stakeholders, investors, lenders, and everybody else involved. So psychology-wise, right now, things are just sort of on a little bit of a pause. It's been a few months now, and people start getting angsty, and they want to invest and they want to lend, but it's still very cautious, and taking the right steps is always the right thing. Not jumping in headfirst, because there's always time. Right? Anybody that jumps headfirst into something may not be seeing what they're getting into. So I would say tread cautiously, underwrite and assess the specific property, the specific market, before just making a rash decision, which I'm sure many of you aren't going to do. But sometimes you get motivated by a deal that you think looks really good and you want to do it, and you might get into a lot more trouble than it's actually worth. So that's sort of the sentiment of where I think the market is today. And I think that's pretty much it for what we got, guys. Listen, be well. I wish you guys the best. Continue working hard, pressing forward. Take care. We'll see you soon.
15 Minutes with Marlon, trending news and headlines.